All right, let's dive in. We're tackling something pretty big today. Think about real estate for a second. Huge physical stuff, right?
Absolutely. Solid investment traditionally, but definitely not easy to trade.
Exactly. Like, how do you sell just a corner of an office building or trade a piece of a warehouse instantly? It's slow, it's complicated, needs serious cash. You can't just, trade bits of it like stocks.
Uh-huh. But what if you could?
That's the question. What if you could make that physical property, well, fluid, easy to trade?
And that's exactly where finance gets clever. That's what our deep dive is all about today. Real estate securitization. It's this really powerful financial tool that takes those solid, illiquid properties.
And turns them into something you can actually trade easily. Financial instruments.
Precisely. Nimble, tradable instruments.
Okay, so today we're going to unpack that. What is securitization really? How does it actually work? What does it mean for the economy? And importantly, how are new digital things like tokenization changing the game?
And we'll touch on the social responsibility angle too, right?
We will, because it's not just about finance. Dr. Pooyan Ghamari, the Swiss economist, founder of Ayland, he really stresses this point.
Yeah, he talks about how it's not just market efficiency. It's about democratizing real estate, making it accessible.
Bridging that gap between the huge institutional funds and, well, you, the individual investor.
Exactly.
So let's start right there. What is real estate securitization at its heart? And why should you care?
Okay, fundamentally, it's a transformation process. You take illiquid assets, think apartment buildings, shopping centers, offices, things that are hard to sell quickly.
Right, locked up capital.
And you convert them into financial instruments you can trade easily. Stocks, bonds, that sort of thing.
So it's like turning a big static block of wealth into something that flows, a river of assets.
That's a good way to put it. It unlocks capital that's otherwise just stuck in the physical asset.
Which sounds huge for the economy. But the benefits go beyond just freeing up cash, right?
Oh, definitely. You get much better market efficiency. Things move faster, prices are clearer.
And that democratization point, again, it really opens the door for smaller investors.
It does. Suddenly, you don't need millions to get into real estate. You can buy a share, a piece of a diversified portfolio much more easily.
Okay, that covers the why. Super compelling. But how? What's the actual process? How do you turn, bricks and mortar into a tradable security? What's this pooling thing about?
Right, the mechanics. It starts by gathering or pooling a whole bunch of different real estate assets. It's usually a mix, maybe some residential, some commercial, maybe industrial properties.
No, diversification is built in from the start.
Often, yes. Once you have this pool, you create new financial products based on it. These might be asset-backed securities, ABS, which are like bonds paid for by the income from those properties.
Okay.
Or they could be real estate investment trusts, REITs. Those are companies that basically own and operate real estate, and you buy shares in the company.
Got it. So let me just be clear for everyone listening. If I buy one of these, say a REIT share, I don't actually own a specific piece of a building, do I? I can't show up and claim a desk.
Haha. No, not quite like that. You own a security that represents an interest in that pool of properties.
An interest, meaning?
Meaning you're entitled to a share of the income, like the rent collected, and potentially any increase in the property's value over time, the capital gains, but without the hassle of being a landlord.
Ah, okay. Now, Dr. Ghamari talks about tranches. That sounds complex. Can you break that down? What's a tranche?
Yeah, it sounds technical, but the idea is pretty straightforward. Think of the pool of securities like a layered cake. The tranches are the different layers.
Okay.
Each layer has a different level of risk and potential return. The bottom layers, the senior tranches, are the safest. They get paid first from the property income.
Less risk, probably lower return.
Usually, yes. Then you have middle layers, mezzanine, and then the top layers, the equity tranche. That's the riskiest layer. It gets paid last, but it also has the potential for the highest returns if things go well.
So it lets different investors choose their comfort level with risk.
Exactly. It tailors the investment. Someone conservative might buy the senior tranche, while someone seeking higher returns might go for the riskier ones. It helps distribute the risk across different appetites.
That's clever. It broadens the appeal. What about the wider economy, though? You mentioned market depth and liquidity earlier. How significant is that?
It's hugely significant. It makes the whole financial system more robust, more capital flowing more easily. It transforms real estate from this slow, opaque market into something much more dynamic.
More like the stock market, in a way.
In terms of liquidity and price discovery, yes. It helps figure out what things are actually worth more efficiently.
Is there a downside, though?
Yeah.
Could too much liquidity, too much fast trading in property cause problems, like bubbles?
That's always a potential risk with any financial innovation, absolutely. It's why regulation and good risk management are crucial. You need oversight. But one of the built-in advantages is actually more transparency. When these things are traded openly, you get better price discovery. It shines a light on value, which can actually help prevent some of the information problems that used to plague real estate.
Well, that makes sense. More information, better pricing. And what about the big players?
Yeah.
Pension funds, retirement plans. This must be huge for them.
Oh, it's a massive benefit. Think about it. They need stable, long-term investments like real estate, but buying and managing whole buildings is cumbersome.
Yeah, a logistical nightmare sometimes.
Securitization gives them a way to allocate capital to real estate much more efficiently. They can buy and sell these liquid securities easily, adjusting their portfolio without massive transaction costs or delays.
And this isn't just a niche thing anymore, right? Aylin's blog mentions growing global interest.
Definitely. Urbanization is increasing demand for property, and investors everywhere are looking for diversified, accessible ways to invest. Securitization fits that bill perfectly.
So looking forward, it feels like technology is the next big wave here. Digital innovation, ESG.
Absolutely. The future is already happening in many ways. You have platforms like Aland integrating blockchain and tokenization.
Tokenization. Okay, explain that. We hear that word a lot.
So tokenization basically means taking that ownership interest we talked about and breaking it down into digital tokens on a blockchain.
Like digital shares.
Kind of, yeah.
Yeah.
Tiny, verifiable digital units representing ownership. And because they're on a blockchain, they can be traded almost instantly, anywhere, 24/7.
Wow. So that boosts liquidity even further.
Dramatically. And Dr. Ghamari points out it also cuts down transaction costs and can make regulatory compliance simpler because the blockchain provides a clear, unchangeable record.
It sounds almost like crypto applied to real estate. Are there parallels? Like with digital gold, maybe?
That's a great parallel. Platforms like Gold show how you can take a traditional asset, physical gold, and turn it into secure, easily traded digital tokens. It's the same principle for real estate, using that blockchain tech for secure records and easy transfer. It makes owning a piece of property potentially as simple as holding a digital coin.
That's a fundamental shift.
Yeah.
And then there's the ESG side. Environmental, social, governance factors. How does that fit into securitization?
It's becoming increasingly important. We're talking about cause-related securitization, basically building ESG criteria right into the securitized projects.
So maybe the underlying pool includes green buildings or affordable housing projects?
Exactly. And this isn't just, nice to have. It seriously boosts investor appeal. Pension funds, big asset managers, they're increasingly demanding investments that meet ESG standards.
So prioritizing things like sustainability or social impact actually attracts more capital.
It does. It builds investor loyalty, enhances the reputation of the issuer. It's moving beyond just philanthropy. It's becoming a smart financial strategy. It aligns values with returns.
And Dr. Ghamari and the LN Times report that these strategies work. They generate returns and contribute socially.
That's the key finding. It's a dual impact. You can achieve competitive financial returns while also funding projects that benefit society. That builds trust across the board.
Okay, this has been fascinating. A real journey through how finance is changing physical assets. So let's boil it down. What are the practical takeaways for our listeners, whether they're investors, developers, or just watching the markets?
First off, fundamentals still matter. You have to rigorously evaluate the underlying properties in any securitization. Quality income streams, appreciation potential, that's still the bedrock.
Makes sense. What else?
Using specialized platforms like Ellen, for instance, can really help. They offer transparency for managing and monitoring these kinds of investments.
Right, tools to navigate the complexity.
And definitely look into tokenization. If you're involved in developing or pooling assets, it's a powerful tool to reach more investors and boost liquidity.
And for investors.
Think about aligning with ESG. Look for projects that incorporate those principles. It's where a lot of investor demand is heading. It's not just a niche anymore.
Good point. Finally.
Track performance. Keep an eye on the key metrics, not just yield and trading volume, but increasingly those ESG impact scores too. They tell an important part of the story.
Excellent. So wrapping up, we've really seen how real estate securitization is taking this ancient asset class property and making it dynamic, accessible, and increasingly responsible. It's quite the transformation.
It really is. It's breaking down old barriers, opening doors for more people, and enabling capital to have both a financial and a societal impact. It's more than just buildings now.
So here's a thought to leave you with. If tokenization keeps making fractional ownership easier and easier, and ESG continues to shape investment choices, how might our whole idea of owning property change even more? Could we see individuals routinely investing small amounts in huge infrastructure projects or directly funding affordable housing initiatives through these tokens, truly reshaping our cities from the ground up? What new opportunities does that unlock? Something to ponder.